In this presentation, we will continue on with our ratio analysis, this time taking a look at solvency ratios within our financial analysis sample report. Here we are in Chapter 5, Analysis of Solvency. We've got our information. We're going to go into the analysis. We have the solvency ratio analysis in terms of a chart. Then we're going to take a look at the debt equity, the loan funds divided by the total shareholders. And note, we're not going to go into the calculations here. We're basically going to look at the formula, look at the data, and then we're going to go to any information that they provide on it in terms of analysis. So here we have the debt to equity ratios. If we consider the analysis, we have this ratio is used to compare the amount of debt a company has with the amount of the owners have invested in the company. It compares the amount of creditors' claim to the owners' claim to the assets of the firm. Trend shows that in 2005, the company was highly leveraged, but after it has managed to control this ratio in the year 2006 and 2007. So we have the basic trend here. We're saying highly leveraged, which means that we have a lot of liability as compared to the equity in that case. So we're leveraged on the firm. So that could be considered, in essence, a bad thing. And then we see the trend taking control or less leverage happening, meaning more being controlled by the equity as opposed to the liability. Now note that they're noting the trend once again, but not a whole lot of detail as to why. So why were we highly leveraged? And, why did the trend stop? What changed? And that's what we would want to get more detail in if we were looking at these in a very detailed way. Note the software can give this kind of generic type of answer. The software can say, here's the trend, here's what it means, and here's what that generally means. So, it was looking highly leveraged, and then it became less leveraged at this point. That's all the software can do. In order for us to dig deeper, we have to say, well, what kind of changes, what decisions were made that actually resulted in that to be happening? And that's the further analysis that we typically would want to get into. Next, we have the interest coverage ratio, the profit before interest and tax divided by the interest expense. Here we have the ratios and the analysis. This ratio suggests that whether a company manages to earn sufficient income to cover its expenses. The ratio of the company indicates the company depends much on borrowed funds. The high interest ratio means the company depends more on debt funds. So again, the analysis is going to be pretty vague here. We might want to go into, what is this telling us? Why would we be dependent on the debt funds? And if we were a creditor, we're basically looking into thinking about, well, how many times can they pay over in essence, the interest earned? How likely are they going to be able to pay the interest expense given the profit of the company?